Again, the goal of GAAPs is to ensure that companies' financial statements are prepared using a consistent set of rules and assumptions so that they can be compared to those of another company in a meaningful way. In this lesson, we'll examine a few of the assumptions that are used when preparing GAAP compliant financial statement. Historical costs. Under GAAP, assets are generally recorded at their historical costs. This seems obvious, but there are times in which it will appear reasonable for a company to report an asset at a value other than the amount paid for. For example, if a company has owned a piece of real estate for several decades, reporting the piece of land at its historic cost may very significantly understate the value of the land. However, if GAAP allows company to use any other valuation methods, current market value for instance, it will introduce a great deal of subjectivity into the process. To use the example of real estate again, depending upon what method you use or who you ask, you can find several different answers for the fair market value of a piece of real estate. Instead, GAAP usually requires that company report asset using the most objective value, the cost that's paid for them. Materiality. Under GAAP, the materiality of a transaction refers to the impact that the transaction will have on company's financial statement. If an omission of a given transaction could cause a viewer of the company's financial statement to make a different decision than he or she would make if the transaction were reported correctly, the transaction is said to be material. Let's give you an example. Martin's business currently have 50,000 of current asset, 20,000 of current liability, and owes 75,000 on a loan that will be due in 2 years. The loan is clearly material as an exclusion of that amount from the company's balance sheet will very likely lead to potential investor to make a poor decision regarding investing in the company. Here's another example. Carly runs a graphic design business. Her monthly revenue are usually around 20,000 and her monthly expense are approximately at 8,000. In August, Carly purchased $80 worth of office supplies, but she forgets to record the purchase. While Carly should certainly make sure to record the purchase once she notices her error, the $80 expense is clearly immaterial. If creditor were looking at her financial statement as the end of August, the 80 understatement of expense would be unlikely to cause them to make a different decision than they would make if expense had been actually recorded. Monetary unit assumption. GAAP makes this assumption that dollar is a stable measurement of value. It's no secret that this is a faulty assumption due to inflation constantly changing the real value of the dollar. The reason for using such a flawed assumption is that the benefit gained from adjusting the value of an asset on a regular basis to reflect inflation would be far outweighed by the cost in both time and money of requiring company to do so. Entity assumptions. For GAAP purpose, it's assumed that a company is an entirely separate entity from its owner. The concept is known as the entity assumption or entity concept. One important ramification of the entity assumption is that the requirement for documenting transaction between a company and its owner. For example, if you Wally own a business, any transfer from the business bank account to your bank account need to be recorded, despite the fact that it doesn't seem like a transaction in that you're really just moving around your own money. Matching principle. According to GAAP, the matching principle dictates that expense must be matched to the revenue that they help generate, and that they must be recorded in the same period in which the revenue is recorded. The concept goes hand in hand with the concept of accrual accounting. For example, it's a matching principle that dictates that a company's utility expense for the month of March must be recorded in March. The reason is that March utility expense contribute to the production of March revenue, so they must record it in March. Similarly, it is a matching principle that dictates that if a company purchases an asset that is expected to provide benefit to the company for multiple accounting periods, The cost of the asset must be spread out over the period for which it is expected to provide benefit. This process is known as depreciation, and we'll discuss more throughout the next chapter. So here's our quick, simple summary. An asset's historical cost is often quite different from its current market value. However, due to its objective nature, historical cost is generally used when reporting the value of asset under GAAP. A transaction is said to be immaterial if an omission of the transaction would not result in a significant misstatement of the company's financial statement. Under GAAP, in order to simplify accounting, currency is generally assumed to have a stable value. This is known as a monetary unit assumption. For GAAP accounting, a business is considered to be an entirely separate entity from its owner. This is known as the entity concept or entity assumption. According to GAAP's matching principle, expense must be recorded in the same period as the revenue which they help produce.